Hey everybody, welcome back. We didn't have a whole lot of news today, but sometimes that speaks louder than the news itself on those busy days while everybody's biting their fingernails waiting for what's coming next. So let's get into what we have to talk about today. So the main thing on everybody's plate that they're waiting for are these US and China talks going on in London, which aren't over yet. So the US and China talks continue and can even continue into tomorrow. We haven't got any further news on that today, so I'd imagine tomorrow's still a done deal. Expect tomorrow to still go on. But it's being described as really, really well, according to Howard Lutnick. And then Treasury Secretary Scott Bessent described it as productive. So it seems like some good news, but going into a third day, I don't know if that's a good thing or a bad thing because there's really two scenarios. It's either good or it's bad as far as how everything's trending. And if it's good, okay, the negotiations are still ongoing just because there's so many great deals they have to write up. Why didn't we think of that? Let's add that to the contract. Let's just keep on writing it up, and there's just not enough time to add all the great stuff they're going into. Or, and this is a big or, they aren't necessarily seeing eye to eye in these negotiations. So I'd imagine that's why we're not getting further news. Trump's not talking about how great it's going. You know, that man's quick to give like 30 posts in a row about how great something's going and how he's the first president to do this and how everything's booming. We're not getting that. We're just getting Howard Lutnick and Secretary Scott Bessent kind of commenting on it. And you know they're negotiating back and forth with Trump. So I'd imagine a true agreement will take a lot longer than just 2 to 3 days. And I don't think a lot of investors in this market are considering how long China and the US can take to actually come to a firm agreement, a firm handshake. They're just waiting on great news to come out, and I'd imagine this real agreement will take a lot longer. We also got the National Federation of Independent Business Optimism Index today, and what we've seen is that the index saw its first increase this year, climbing to 98.8 in May, with 7 out of 10 sectors improving on expectations for business conditions and sales to improve. What we also seen is that the uncertainty index also increased, with about 18% of small businesses reporting taxes as their most important problem they have going on. So you could check out this report. It goes further in depth. I'm just going to cover this. I got a basketball sesh to get to. But what else is going on today? Well, we got a warning from the World Bank. And what the World Bank sees is that the economic growth here in the US could be cutting in half as a result to these tariffs that's been ongoing. We don't know what's going to happen with these tariffs, but as long as they're still here, cutting in half economic growth. Now, the global economy, according to the World Bank, is set to suffer a more modest but still significant slowdown. So not quite as bad as the US, but the US economic growth is meant to cut in half, or expected to cut in half. It also warned that the slowdown will be a lot more worse if the tariffs increase again. Who knows if that happens or not. But as of now, the US economy is expected to grow just 1.4%, which is half of the rate back in 2024. And this 1.4% that they came up with, this is down from their January forecast of 2.3% that the World Bank projected back in January. This also aligns up with the OECD's forecast, the Organization of Economic Cooperation and Development's forecast of 1.6%. So they're all around that same ballpark. Now, not a lot of news today. What is everybody waiting on? CPI, we got inflation data tomorrow. Mark your calendars. I even joked that I'd call in sick to work tomorrow to live stream it because this is where everybody's watching. And what we're expecting is a slight uptick from where we have, which this will be the first uptick for the first time in 4 months. Now, headline CPI, Consumer Price Index, is expected to come in at 2.5%, which is up from 2.3% the month prior. Core CPI, which is what more people closely watch, the magnifying glasses on this because it strips out volatile industries like electricity and food, the energy sector, core CPI is expected to come in at 2.9%, up from 2.8%. Goldman Sachs notes that goods prices will be the bulk of the increase that we see, and this makes sense considering tariffs mainly impacts goods and then services indirectly, but mainly the tariffs impact ordering goods and inventory and everything. Now, why is this CPI important anyways? Because PCE is what the Fed watches. Well, CPI is a measure of inflation and it gives insight into the Fed's possible actions based on what they're expected to do. Because what does the Fed do? They want a balanced labor market and they want tamed inflation. So, whenever we get this inflation data, everybody starts guessing, and this CME Fed Watch tool that we're looking at every single day, this is showing what everybody's guessing the Fed's going to do. So we're expecting warmer inflation already. We're still on track. It's slightly falling every single day. This rate cut that we're expected here in September 17th meeting, the chances of that keep slimly going down, but it still seems everything's set. But I'd imagine if there are any real moves in this target probability, it'll be because of inflation. So what we're going to be watching for is, does inflation come in hot? Does it come in right at expected for this core CPI, which is expected to come in at 2.9%, only up 0.10%? Or does it come in cold? And that'll give us an idea as to what the Fed's reactions might be. Now, are we going to get rates higher for longer if this inflation comes in hotter than expected? Like, all right, well, just imagine the Fed throws their hands up in the air. Well, we can't cut yet. So that just means higher rates for longer. Expect rates to not go down in the near future. Or if it comes in super hot, I mean, I'd imagine the now it might not happen, like it could just be a scare tactic, but the if inflation just came in super hot somehow, that could be the scenario where the idea, not the actual happening of, but the idea of rate hikes happening all over again, all in the face of other central banks around the globe cutting rates. So everybody's going to be watching that. And if CPI comes in kind of low, that could support a Fed that is willing to cut rates here pretty soon. So it all depends on the severity and whether the surge in prices is temporary or not. We're expecting CPI and inflation to come in a bit more hot just leading into the summer, but will this just be the summer months and maybe, just a little bit after summer, or are we expecting the rest of the year to have elevated inflation? Now, we also got some news about Scott Bessent. Oh, wait. U.S. China officials say consensus reached on Geneva framework. So that's interesting. We'll check Wall Street Journal here in a bit. But what I was going to say is Bessent is emerging as the contender to succeed Fed Powell. So what we could possibly see, we don't know if he'll be doing both jobs as the Treasury Secretary under Trump and work for the Federal Reserve Central Bank as the Fed chair. Technically, that wouldn't really show the central bank's independence from the government, so maybe I'd imagine he steps away from the Treasury Secretary position. And what would this really mean in the case that the Treasury Secretary Scott Bessent becomes the Fed chair? Well, he's been really focused on, hey, we need to get this deficit down, we need to get this 10-year Treasury rate down, 10-year Treasury yield down, and a lot of these longer term bond yields, which all impact borrowing costs. So that could be seen as good news, and the stock market's looking for anything solidifying good news. Because right now, the stock market would love another green light to rally, although it's getting pretty tight, and that's what this article's talking about, that stocks haven't been this expensive relative to bonds in almost 25 years. Is a market downturn next? And this is by Joy Wiltermuth. And pretty much what she's identifying is that the equity risk premium is at zero, which hasn't happened in almost 25 years. All right, so we're learning here. So let's look at what the equity risk premium even stands for. So ERP is the additional return investors expect to earn for investing in stocks rather than risk-free investments like government bonds, which are virtually risk-free, right? It represents the compensation for the higher risk associated with equity investments. The risk-free rate, equity risk premium formula. So the equity risk premium formula equals the expected return on equities minus the risk-free rate. Why it exists: investors demand a higher return for taking on the risk of investing into the stock market, where there's chance of losing money. The ERP is a key factor in determining the cost of capital for companies and is used in financial models like the CAPM, the capital asset pricing model. Interesting. Now, back to the article. The only two times that we've seen this in the last 70 years was 1987, and then a period in the second one. It was 1996 to 2001. And during this, where the equity risk premium was zero, what followed was a market downturn. So the market tanked. The stock market tanked 25% following the 1987 ERP of zero, and then 40% during that range of 1996 to 2001. And at the same time of the stock market crashing, bonds were in the spotlight. And it's funny that all of this just keeps on surfacing because this comes as these stocks. Like, stocks are pretty good today. And I think it's the absence of bad news was kind of the, they're like biting their fingernails, like waiting to buy. Well, I mean, nothing bad's came out yet. Like, and then they buy. But stocks are testing all-time highs. Like, we're right there. We're right there. Look at that. Hold on. Let's put it on the week chart and then I'm gonna say it again. We're right there. Look at that. Look at the Qs. Look at Amazon. Look at Nvidia. Apple's kind of lagging, but you know, like their event kind of sucked. They admit their AI sucks and it's gonna be a while on that. Look at Google. Look at Meta. AMD's kind of lagging. So overall, I mean, if you're looking at the SPY, if you're looking at the NASDAQ, if you're looking at the Dow Jones, if you're looking at the NASDAQ 100, all of those are near all-time highs. And honestly, the Qs 537, and these are on the week chart, so the numbers will fluctuate a little bit. But I mean, we're like, hold on, what's this high? 538, 540. We're like $6 away from an all-time high, just about. Remember, these are approximates. But as these stocks are testing new all-time highs, while the equity risk premium is at zero, which shows the last two times this has happened, there's been a market downturn, stocks near an all-time high, which the all-time high could serve as a huge psychological barrier, all at the same time as things just aren't better. They're not exactly better. There's not as bad news, tariffs aren't as high, but pretty much these same scenarios where we live right now. It's just we've had it for a little bit, so it's like everybody's used to it. Now, Bank of America reported that their clients have bought stocks the last 25 of the past 26 weeks, which get another record. There's always a record to be broke. And while all of this is happening, stocks near all-time highs again. The fear and greed index is showing, if we can load. Let's just hit this magical refresh. Oh, wow, this is slightly down from where I was looking at it earlier. Let's wait for it to settle loading. All right, yeah, we're still right there, kind of in the middle of the greed and fear index. And this is right as the all-time highs are approaching, and people are just like, man, like this seems pretty much gonna happen, and we've been greed for a while now. I don't want to miss out on that. And what's that saying? FOMO, fear of missing out, and people just buying the dip and looking for a green light to buy. It just kind of interesting to watch. So we'll watch this. We'll watch CPI inflation data coming out tomorrow. Mark your calendars for that one. That is the one. And then we'll just go from there. There's a next catalyst after that, and then after that, and after that. It's just a ton of moving pieces. It's like a train. Choo choo. So that's what I got for today, y'all. Hope your day was great. I'm about to go play some basketball. I'll drop off some buckets and I'll see y'all tomorrow. Y'all have a good one.